Welcome back to the channel of truth, trust, and transparency. Today, I'm talking all things capital gains tax. Now, I personally think that the narrative out there and what a lot of people think, the stereotypical thoughts, feelings, emotions around capital gains tax is wrong. And how I see capital gains tax is obviously most taxes. It's a success fee. Tax is a success fee. If you don't want to pay any tax, pay $18,200 in income, and then you won't have to pay any tax. It is there. Obviously, we want to avoid it when we can. We want to mitigate it where we can. At the end of the day, if you want to earn money in Australia, how the system is set up, you will need to pay it at some point in time. The government does not miss you, no matter what structure, what form you are under. However, I wanted to run through capital gains tax. Now, I know on my particular channel, I've said it before, I'll say it again, is that I don't believe in, a lot of the buyer's agents that tell you to buy one property after 2 years, chase those growth waves, pump and dump and sell and then go again after every 2 years. Because I think the selling costs because I think in those particular circumstances, the property bun has not baked in the oven enough, and then the selling costs do trim down a lot of those margins. So people think that they're going to make a lot of money, and then I think once they sell and they pay everything, it's probably not as much. However, if you have held for a decent amount of time, and obviously it depends on your strategy, not financial advice, 5, 7, 10 years, and that property has grown significantly in value, a lot of people are scared to sell. But in my opinion, capital gains tax is one of the best taxes in Australia. Why? Because my personal tax bracket was 45% plus. If you're on 100 grand, you're paying 22 grand a year in tax anyway. Capital gains tax actually equals out to be around that 22 to 25% mark. And for me, that is fantastic. Australia has a 50% capital gains tax exemption, which I think is a patch in the system that they haven't fixed yet. I think it is absolutely phenomenal. Now, we might not have it forever, but I do believe it is a phenomenal policy to exploit. And I'm going to run you through an example today, which shows you just how much capital gains tax you will pay and how it's not an issue. A lot of people think, if I sell a property, I'm going to pay 50% capital gains tax. Not at all. It equals out to be only about 22 to 25%. You're not going to pay that anywhere else unless you've got a company structure. So if it's in your personal name, let's run through a quick scenario, shall we? $450,000 purchase, and you've decided once the property reaches $1 million, you're going to sell it. Now, obviously, the timeline between here, we do not know, but I don't think it's like what most buyers agents sell it to be, and that is, 2-3 year period. Obviously, this might be to get from there to there. It might be 5, it could be 7, it could be 10 years. But this is why it doesn't hurt to sell. Now, obviously, when I originally bought that, I paid a $45,000 deposit. I paid stamps, LMI, legals, blah, blah, blah. I spent $80,000 to buy that house. We know that $45,000 of that 80 was the deposit, and $35,000 was my other costs, stamps, legals, all that kind of stuff. They were my buying price. They were the costs associated with buying the property, and I sold it for $1 million. I paid $5 grand in marketing, legals, and then I paid the selling agent $20,000, 2%. Now, when I calculate my cost base, I add the purchase price. I add this $35,000, which is the other costs associated with purchasing the property. I also add in what my selling costs are, which are these three. Now, obviously, in this particular instance, there's no depreciation. If you're looking for the depreciation and how that's worked out, I've done videos on my channel of that, so definitely scroll back and have a look. If you're finding value from these type of videos or anything else I've posted, it'll be really cool if you just hit subscribe. I'm trying to get my channel to 1,000 subscribers by the end of the year. I've been posting every single day for over a month now, so I'd really appreciate it, because YouTube tells me about 70% of people that watch my videos haven't actually subscribed. A little bit rude, but it's probably buyer's agents, so anyway, I don't blame them. So calculating my cost base, my purchase price, my prices associated with buying, my prices associated with selling. Now, obviously, we're not doing depreciation. You go back to that video if there was depreciation and how it's worked into that cost base. Meaning I have a cost base of $513,000 total. Now, Sell price $1 million. We minus our cost base. It means I have made a $487,000 profit. First and foremost, people actually get this wrong. I hear some people do a calculation. They go, oh yeah, I've made $550,000. Brother, you have not. You got to add your cost base onto there, because that's what I bought for, but that's not what my cost was. My cost was that plus these and also these fees there. So I've spent $513,000 in costs, $1 million property, meaning I've made 487. Now, this is the beauty of this. Once I sell this property, I will keep 50% of this amount. This is the 50% capital gains exemption. This I love. 50% of that, I will keep tax-free in your account, ready to spend on whatever you want. You don't have to pay a cent of tax on it. $243K. Then on the second lot of 243, because remember we split this into two, I will need to pay a tax percentage. I'm pretty sure that should be right, 45%. Now on the second 50%, I'm going to pay about 45% of that in tax, which equals $109,557. I take that off the original 243 and I'm left with $133,000 to keep after I've paid my dues. I add both of those together and I'm going to profit $377,425. Now we look at the $133,000 as a percentage on my total profits. It's not 50%. On the profits that I've made from this entire deal, 457, the tax that I've paid, which is 109, equals 22.5%. Now, obviously, Medicare leaving that kind of stuff, but it's only 22%. In my opinion, there's no other way you can get out of paying that little tax bracket for earning that much money. If you're in your 9-to-5 job and you're earning $487,000, then you're paying 45% of that tax. So in my opinion, that's why property is such a great vehicle of when it does those numbers and you can sell it and you can exploit the capital gains tax exemption. On 487, I'm paying 22.5% tax. Come on, guys. It's beautiful. It's so much better than earning 487 in your 9-to-5 job because you're going to pay 45% tax on it. So that's why I think a lot of people complain about capital gains tax and say, oh, I've got to pay all this capital gains tax. Where are you going to pay such little tax else in your life if you're a 9-to-5 employee on that much money? You're not. So why are you complaining? You probably don't know how it works. But that's my opinion. That's my thoughts. Capital gains tax, I think it is absolutely an incredible system that you can exploit as a property investor. Obviously, it's all legal. Obviously, it's all above board. Not financial advice, of course. This is just theory. This is just education. Obviously, we want to make sure that the numbers between what I'm buying for, what I'm selling for, I run these numbers too to see what my outcome's going to be. Probably need to talk to your accountant for that because there might be some depreciation or anything like that. However, in my opinion, capital gains tax gets the thumbs up. I think most people look at it wrong. $377,000. Not bad if you can get it, in my opinion. Let me know your thoughts, queries, questions, comments below. As always, would appreciate it if you subscribe. Whether you do or you don't, it is what it is, and I'll see you guys tomorrow.